thereafter. CFB, April 2015, TILA 17. CFPB, Laws and Regulations, TILA. Subpart B, Open-End Credit. Subpart B relates to open-end credit. It contains rules on account opening disclosures 1026.6 and periodic statements 1026.7 to 8. It also describes special rules that apply to credit card transactions, treatment of payments 1026.10 and credit balances 1026.11, procedures for resolving credit billing errors 1026.13, annual percentage rate calculations 1026.14, rescission requirements 1026.15, and advertising 1026.16. Time of disclosures periodic statements, section 1026.5b. For credit card accounts under an open-end, not home-secured consumer credit plan, creditors must adopt reasonable procedures designed to ensure that periodic statements are mailed or delivered at least 21 days prior to the payment due date disclosed on the periodic statement, and that payments are not treated as late for any purpose if they are received within 21 days after mailing or delivery of the statement. In addition, for all open-end consumer credit account grace periods, creditors must adopt reasonable procedures designed to ensure that periodic statements are mailed or delivered at least 21 days prior to the date on which a grace period, if any, expires, and that finance charges are not imposed as a result of the loss of a grace period if a payment is received within 21 days after mailing or delivery of a statement. For purposes of this requirement, a grace period is defined as a period within which any credit extended may be repaid without incurring a finance charge due to a periodic interest rate. For non-credit card open-end consumer plans without a grace period, creditors must adopt reasonable policies and procedures designed to ensure that periodic statements are mailed or delivered at least 14 days prior to the date on which the required minimum periodic payment is due. Moreover, the creditor must adopt reasonable policies and procedures to ensure that it does not treat as late a required minimum periodic payment received by the creditor within 14 days after it is mailed or delivered the periodic statement. Subsequent disclosures open-end credit. Section 1026.9. For open-end, not home-secured credit, the following applies. Creditors are required to provide consumers with 45 days advance written notice of rate increases and other significant changes to the terms of credit card account agreements. The list of significant changes includes most fees and other terms that a consumer should be aware of before use of the account. Examples of such fees and terms include penalty fees, transaction fees, fees imposed for the issuance or availability of the open-end plan. CFPB, April 2015, TILA 18. CFPB, Laws and Regulations, TILA. Grace period and balance computation method. Changes that do not require advance notice include reductions of finance charges, termination of account privileges resulting from an agreement involving a court proceeding. The change is an increase in an APR upon expiration of a specified period of time previously disclosed in writing. The change applies to increases in variable APRs that according to an index not under the card issuer's control, and rate increases due to the completion of or failure of a consumer to comply with the terms of a workout or temporary hardship arrangement, if those terms are disclosed prior to commencement of the arrangement. Auditor may suspend account privileges, terminate an account, or lower the credit limit without notice. However, a creditor that lowers the credit limit may not impose an over-limit fee or penalty rate as a result of exceeding the new credit limit without a 40% 5-day advance notice that the credit limit has been reduced. For significant changes in terms, with the exception of rate changes, increases in the minimum payment, changes in the balance computation method, and when the change results from the consumer's failure to make a required minimum periodic payment within 60 days after the due date, a creditor must also provide consumers the right to reject the change. If the consumer does reject the change prior to the effective date, the creditor may not apply the change to the account 1026.9 ed 2I. In addition, when a consumer rejects a change or increase, the creditor must not impose a fee or charge or treat the account as in default solely as a result of the rejection, or require repayment of the balance on the account using a method that is less beneficial to the consumer than one of the following methods. 1. The method of repayment prior to the rejection. 2. An amortization period of not 5 years from the date of rejection. Or 3. A minimum periodic payment that includes a percentage of the balance that is not more than twice the percentage included prior to the date of rejection. Finance charge, open-end credit, sections 1026.6A1 and 1026.6B3. Each finance charge imposed must be individually itemized. The aggregate total amount of the finance charge need not be disclosed. CFPB April 2015 TILA 19. CFPB Laws and Regulations TILA. Determining the balance and computing the finance charge. The examiner must know how to compute the balance to which the periodic rate is applied. Common methods used are the previous balance method, the daily balance method, and the average daily balance method, which are described as follows. Previous balance method. The balance on which the periodic finance charge is computed is based on the balance outstanding at the start of the billing cycle. The periodic rate is multiplied by this balance to compute the finance charge. Daily balance method. A daily periodic rate applied to either the balance on each day in the cycle or the sum of the balances on each of the days in the cycle. If a daily periodic rate is multiplied by the balance on each day in the billing cycle, the finance charge is the sum of the price. If the daily periodic rate is multiplied by the sum of all the daily balances, the result is the finance charge. Average daily balance method. The average daily balance is the sum of the daily balances, either including or excluding transactions, divided by the number of days in the billing cycle. A periodic rate is then multiplied by the average daily balance to determine the finance charge. If the periodic rate is a daily one, the product of the rate multiplied by the average balance is multiplied by the number of days in the cycle. In addition to those common methods, financial institutions have other ways of calculating the balance to which the periodic rate is applied. By reading the financial institution's explanation, the examiner should be able to calculate the balance to which the periodic rate was applied. In some cases, the examiner may need to obtain additional information from the financial institution to verify the explanation disclosed. Any inability to understand the disclosed explanation should be discussed with management, who should be reminded of Regulation Z's requirement that disclosures be clear and conspicuous. When a balance is determined without first deducting all credits and payments made during the billing cycle, that fact and the amount of the credits and payments must be disclosed. If the financial institution uses the daily balance method and applies a single daily periodic rate, disclosure of the balance to which the rate was applied may be stated as any of the following. A balance for each day in the billing cycle. The daily periodic rate is multiplied by the balance on each day, and the sum of the products is the finance charge. A balance for each day in the billing cycle on which the balance in the account changes. The finance charge is figured by the same method as discussed previously, but the statement shows the balance only for those days on which the balance changed. The sum of the daily balances during the billing cycle. The balance on which the finance charge is computed is the sum of all the daily balances in the billing cycle. The daily periodic rate is multiplied by that balance to determine the finance charge. CFPB April 2015 TILA 20. CFPB Laws and Regulations TILA. The average daily balance during the billing cycle. If this is stated, the financial institution may, at its option, explain that the average daily balance is or can be multiplied by the number of days in the billing cycle and the periodic rate applied to the product to determine the amount of interest. If the financial institution uses the daily balance method but applies 2 or more daily periodic rates, the sum of the daily balances may not be used. Acceptable ways of disclosing the balances include a balance for each day in the billing cycle, a balance for each day in the billing cycle on which the balance in the account changes, or 2 or more average daily balances. If the average daily balances are stated, the financial institution may, at its option, explain that interest is or may be determined by 1. Multiplying each of the average daily balances by the number of days in the billing cycle, or if the daily rate varied during the cycle. 2. By multiplying each of the results by the applicable daily periodic rate. And 3. Adding these products together. In explaining the method used to find the balance on which the finance charge is computed, the financial institution need not reveal how it allocates payments or credits. That information may be disclosed as additional information, but all required information must be clear and conspicuous. Note: Section 1026.54 prohibits a credit card issuer from calculating finance charges based on balances for days in previous billing cycles as a result of the loss of a grace period, a practice sometimes referred to as double cycle billing. Finance charge resulting from 2 or more periodic rates. Some financial institutions use more than one periodic rate in computing the finance charge. For example, one rate may apply to balances up to a certain amount, and another rate to balances more than that amount. If 2 or more periodic rates apply, the financial institution must disclose all rates and conditions. The range of balances to which each rate applies also must be disclosed. It is not necessary, however, to break the finance charge into separate components based on the different rates. Annual percentage rate, open-end credit. The disclosed APR on an open-end credit account is accurate if it is within 1/8 of 1 percentage point of the APR calculated under Regulation Z. Determination of APR, Section 1026.14. The basic method for determining the APR in open-end credit transactions involves multiplying each periodic rate by the number of periods in a year. This method is used in all types of open-end disclosures, including CFPB April 2015 TILA 21. CFPB Laws and Regulations TILA. The corresponding APR in the initial disclosures. The corresponding APR on periodic statements. The APR in early disclosures for credit card accounts. The APR in early disclosures for home equity plans. The APR in advertising and APR in oral disclosures. The corresponding APR is prospective, and it does not involve any particular finance charge or periodic balance. A second method of calculating the APR is the quotient method. At a creditor's option, the quotient method may be disclosed on periodic statements for home equity plans subject to Section 1026.40, HELOCs. 5. The quotient method reflects the annualized equivalent of the rate that was actually applied during a cycle. This rate, also known as the effective APR, will differ from the corresponding APR if the creditor applies minimum, fixed, or transaction charges to the account during the cycle. 1026.14C Brief Outline for Open-End Credit APR. Calculations on periodic statements. Note: assume monthly billing cycles for each of the calculations below. First basic method for determining the APR in an open-end credit transaction. This is the corresponding APR. 1026.14 BA. Monthly rate X12. Equal to APR, second optional effective APR that may be disclosed on home equity line of credit HELOC. Periodic statements. APR, when only periodic rates are imposed. 1026.14C. Monthly rate X12, equal to APR. Or 2. Total finance charge, sum of the balances X12 equal to APR B. APR when minimum or fixed charge but not transaction charge imposed. 1026.14 CT5. If a creditor does not disclose the effective or quotient method APR on a HELOC periodic statement, it must instead disclose the charges, fees, and interest imposed as provided in Section 1026.7A. CFPB, April 2015, TILA 22. CFPB, Laws and Regulations TILA. 1. Total finance charge, amount of applicable balances 6x12, equal to APR 7. APR, when the finance charge includes a charge related to a specific transaction, such as a cash advance fee, even if the total finance charge also includes any other minimum, fixed, or other charge not calculated using a periodic rate. 1026.14 C. 3. 1. Total finance charge, all balances other amounts on which a finance charge was imposed during the billing cycle without duplication 8. X12 equal to APR 9. D. APR when the finance charge imposed during the billing cycle includes a minimum or fixed charge that does not exceed for a monthly or longer billing cycles, or pro rata part of, for a billing cycle shorter than, monthly, 1026.14 C1, monthly rate x12 equal to APR. APR calculation when daily periodic rates are applicable if only the periodic rate is imposed or when a minimum or fixed charge, but not a transactional charge, is imposed. 1026.1 Ford. Total finance charge average daily balance x12 equal to APR. Or 2. Total finance charge sum of daily balances x365 equal to APR. Change in terms notices for home equity plans subject to Section 1026.40, Section 1026.9c. Servicers are required to provide consumers with 15 days advance written notice of a change to any term required to be disclosed under Section 1026.6a, or where the required minimum periodic payment is increased. Notice is not required when the change involves a reduction of any component of a finance charge or other charge, or when the change results from an agreement involving a court proceeding. If the creditor prohibits additional extensions of credit or reduces the credit limit in certain circumstances, if permitted by contract, a written notice must be provided no later than 3 business days after the action is taken and must include the specific reasons for the action. If the creditor requires the consumer to request reinstatement of credit privileges, the notice also must state that fact. For the following formulas, the APR cannot be determined if the applicable balance is 0. 1026.14 C7 loan fees, points, or similar finance charges that relate to the opening of the account must not be included in the calculation of the APR. The sum of the balances may include the average daily balance, adjusted balance, or previous balance method. When a portion of the finance charge is determined by application of one or more daily periodic rates, the sum of the balances also means the average of daily balances. See Appendix F to Regulation Z. 9 cannot be less than the highest periodic rate applied, expressed as an APR. Loan fees, points, or similar finance charges that relate to the opening of the account must not be included in the calculation of the APR. CFPB, April 2015, TILA 23. CFPB. Laws and Regulations, TILA. Timely Settlement of Estates, Section 1026.11. Issuers are required to establish procedures to ensure that any administrator of an estate can resolve the outstanding credit card balance of a deceased account holder in a timely manner. If an administrator requests the amount of the balance, the issuer is prohibited from imposing additional fees on the account. The issuer is required to disclose the amount of the balance to the administrator in a timely manner, safe harbor of 30 days, and if the balance is paid in full within 30 days after disclosure of the balance, the issuer must waive or rebate any trailing or residual interest charges that accrued on the balance following the disclosure. Minimum payments, Section 1026.7b12. For credit card accounts under an open-end credit plan, card issuers generally must disclose on periodic statements an estimate of the amount of time and the total cost, principal, and interest involved in paying the balance in full by making only the minimum payments, and an estimate of the monthly payment amount required to pay off the balance in 36 months, and the total cost, principal, and interest of repaying the balance in 36 months. Card issuers also must disclose a minimum payment warning, and an estimate of the total interest that a consumer would save if that consumer repaid the balance in 36 months, instead of making minimum payments. Advertising for open-end plans, Section 1026.16. The regulation requires that loan product advertisements provide accurate and balanced information in a clear and conspicuous manner about rates, monthly payments, and other loan features. The advertising rules ban several deceptive or misleading advertising practices, including representations that a rate or payment is fixed when in fact it can change. If an advertisement for credit states specific credit terms, it must state only those terms that actually are or will be arranged or offered by the creditor. If any finance charges or other charges are set forth in an advertisement, the advertisement must also clearly and conspicuously state the following: any minimum, fixed, transaction, activity, or similar charge that is a finance charge under Section 1026.4 that could be imposed. Any periodic rate that may be applied, expressed as an APR as determined under Section 1026.14b. If the plan provides for a variable periodic rate, that fact must be disclosed, and any membership or participation fee that could be imposed. CFPB, April 2015, TILA 24. CFPB. Laws and Regulations, TILA. If any finance charges or other charge or payment terms are set forth, affirmatively or negatively, in an advertisement for a home equity plan subject to the requirements of Section 1026.40, the advertisement also must clearly and conspicuously set forth the following: any loan fee that is a percentage of the credit limit under the plan and an estimate of any other fees imposed for opening the plan stated as a single dollar amount or a reasonable range. Any periodic rate used to compute the finance charge, expressed as an APR as determined under Section 1026.14b, and the maximum APR that may be imposed in a variable rate plan. Regulation Z's open-end home equity plan advertising rules include a clear and conspicuous standard for home equity plan advertisements, consistent with the approach taken in the advertising rules for consumer leases under Regulation M. Commentary provisions clarify how the clear and conspicuous standard applies to advertisements of home equity plans with promotional rates or payments and to internet, television, and oral advertisements of home equity plans. The regulation allows alternative disclosures for television and radio advertisements for home equity plans. The regulation also requires that advertisements adequately disclose not only promotional plan terms, but also the rates or payments that will apply over the term of the plan. Regulation Z also contains provisions implementing the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005, which requires disclosure of the tax implications of certain home equity plans. CFPB, April 2015, TILA 25. CFPB. Laws and Regulations, TILA. Subpart C, Closed-End Credit. Subpart C relates to closed-end credit. It contains rules on disclosures 1026.1720, treatment of credit balances 1026.21, annual percentage rate calculations 1026.22, rescission rights 1026.23, and advertising 1026.24. The TILA-RESPA integrated disclosures must be given for most closed-end transactions secured by real property for which the creditor receives an application on or after August 1, 2015. The TILA-RESPA integrated disclosures do not apply to HELOCs, reverse mortgages, or mortgages secured by a mobile home or by a dwelling that is not attached to real property. Truth in Lending Disclosures TIL disclosures and the Consumer Handbook on Adjustable Rate Mortgages Charm booklet must still be provided for certain limited closed-end loan transactions. First, disclosures generally. A. Timing. Generally, all disclosures provided to consumers must be made clearly and conspicuously in writing, in a form that the consumer may keep 1026.17a, 1026.370, 1026.38. However, the timing of the disclosures may change depending on the transaction. 1026.19a, 1026.19e1, in 26.1 key, 1002. Disclosures in connection with non-mortgage closed-end loans and specified housing assistance loan programs for low and moderate income consumers must be provided before consummation of the transaction. 1026.3 each, 1026.17b, and 1026.18. For most closed-end transactions secured by real property for which the creditor receives an application on or after August 1, 2015, including construction-only loans, loans secured by vacant land or by 25 or more acres, and credit extended to certain trusts for tax or estate planning purposes, disclosures must be provided in accordance with the timing requirements outlined in 12 CFR 1026.19e F and G. A creditor is required to mail or deliver the loan estimate within 3 business days of receipt of the consumer's loan application and to ensure that the consumer receives the closing disclosure no later than 3 business days before loan consummation. 1026.19 EHU, 1026.19 F1. If the loan is a purchase transaction, the special information booklet must also be provided within 3 business days of receipt of the consumer's application. 1026.19 J. The specifics of these disclosure timing requirements are further discussed below, including a discussion about revised disclosures. Mortgage loans not subject to 12 CFR 1026.19E and FEG reverse mortgages and chattel dwelling loans have different disclosure requirements. For reverse mortgages, disclosures must be delivered or mailed to the consumer no later than the 3rd business day after a creditor receives the consumer's written application. 1026.19A. For chattel dwelling mortgage loans, disclosures must be provided to the consumer prior to consummation of the loan. 1026.17B. Revised disclosures are also required within 3 business days of consummation if certain mortgage loan terms change. 1026.19A2. For loans like reverse mortgages, the consumer. CFPB April 2015 TILA 26. CFPB. Laws and Regulations TILA. Will receive the Good Faith Estimate GFE, HUD-1 Settlement Statement HUD-1, and Truth in Lending disclosures as required under the applicable sections of both TILA and RESPA. Consumers receive TIL disclosure for chattel dwelling loans that are not secured by land, but the GFE and the HUD-1 are not required. Finally, certain variable rate transactions secured by a dwelling have additional disclosure obligations with specific timing requirements, both prior to and after consummation. See 1026.20C and D below. B. Basis for disclosures. 1. Generally, disclosures provided for closed-end transactions must reflect the credit terms to which the parties will be legally bound as of the outset of the credit transaction. If information required for the disclosures is unknown, the creditor may provide the consumer with an estimate, using the best information reasonably available. The disclosure must be clearly marked as an estimate, variable and adjustable rate. If the terms of the legal obligation allow the financial institution, after consummation of the transaction, to increase the APR, the financial institution must furnish the consumer with certain information on variable rates. Variable rate disclosures are not applicable to rate increases resulting from delinquency, default, assumption, acceleration, or transfer of the collateral. Some of the more important transaction-specific variable rate disclosure requirements follow. Disclosures for variable rate loans must be given for the full term of the transaction and must be based on the terms in effect at the time of consummation. If the variable rate transaction includes either a seller buy-down that is reflected in a contract or a consumer buy-down, the disclosed APR should be a composite rate based on the lower rate for the buy-down period and the rate that is the basis for the variable rate feature for the remainder of the term. If the initial rate is not determined by the index or formula used to make later interest rate adjustments, as in a discounted variable rate transaction, the disclosed APR must reflect a composite rate based on the initial rate for as long as it is applied and, for the remainder of the term, the rate that would have been applied using the index or formula at the time of consummation, i.e. the fully indexed rate. O. If a loan contains a rate or payment cap that would prevent the initial rate or payment at the time of the adjustment from changing to the fully indexed rate, the effect of that rate or payment cap needs to be reflected in the disclosures. The index at consummation need not be used if the contract provides a delay in the implementation of changes in an index value, e.g., the contract indicates that future rate changes are based on the index value in effect for some specified period, like 45 days before the change date. Instead, the financial institution may use any rate from the date. CFPB, April 2015, TILA 27. CFPB, Laws and Regulations TILA. Of consummation back to the beginning of the specified period, e.g. during the previous 45-day period. If the initial interest rate is set according to the index or formula used for later adjustments is set at a value as of a date before consummation, disclosures should be based on the initial interest rate, even though the index may have changed by the consummation date. CFPB 2015 TILA 28. CFPB, Laws and Regulations TILA. 2. Finance charge, amount financed and APRs. A. Finance charge, Section 1026.18C. The aggregate total amount of the finance charge must be disclosed for all loans. An itemization of the amount financed is required, except as provided in 12 CFR 1026.18 C2 or C, unless the loan is subject to 12 CFR 1026.19 E and FIE, most closed-end mortgage loans. Amount financed, Section 1026.18B, 1026.380. 1. Definition, extended for the consumer. It should not be assumed that the amount financed under the regulation is equivalent to the note amount, proceeds, or principal amount of the loan. Amount financed normally equals the total of payments less the finance charge. To calculate the amount financed, all amounts and charges connected with the transaction, either paid separately or included in the note amount, must first be identified. Any prepaid, precomputed, or other finance charge must then be determined. The amount financed must not include any finance charges. If finance charges have been included in the obligation, either prepaid or precomputed, they must be subtracted from the face amount of the obligation when determining the amount financed. The resulting value must be reduced further by an amount equal to any prepaid finance charge paid separately. The final resulting value is the amount financed. When calculating the amount financed, finance charges, whether in the note amount or paid separately, should not be subtracted more than once from the total amount of an obligation. Charges not in the note amount and not included in the finance charge, e.g., an appraisal fee paid separately in cash on a real estate loan, are not required to be disclosed under Regulation Z and must not be included in the amount financed. In a multiple advance construction loan, proceeds placed in a temporary escrow account and awaiting disbursement in draws to the developer are not considered part of the amount financed until actually disbursed. Thus, if the entire commitment amount is disbursed into the lender's escrow account, the lender must not base disclosures on the assumption that all funds were disbursed immediately, even if the lender pays interest on the escrowed funds. 2. Calculating the amount financed. A consumer signs a note secured by real property in the amount of $5,435. The note amount includes $5,000 in proceeds disbursed to the consumer, $400 in precomputed interest, $25 paid to a credit reporting agency for a credit report, and a $10 service charge. Additionally, the consumer pays a $50 loan fee separately in cash at consummation. The consumer has no other debt with the financial institution. The amount financed is $4,975. CFPB, April 2015, TILA 29. CFPB. Laws and Regulations, TILA. The amount financed may be calculated by first subtracting all finance charges included in the note amount, $5,435 to $400, $10 equal to $5,000 to $25. The $20 credit report fee is not a finance charge because the loan is secured by real property. The $5,025 is further reduced by the amount of prepaid finance charges paid separately for an amount financed of $5, $0, $25, $50, $4,975. The answer is the same whether finance charges included in the obligation are considered prepaid or precomputed finance charges. The financial institution may treat the $10 service charge as an addition to the loan amount and not as a prepaid finance charge. If it does, the loan principal would be $5,000. The $5,000 loan principal does not include either the $400 or the $10 precomputed finance charge in the note. The loan principal is increased by other amounts that are financed which are not part of the finance charge, the $25 credit report fee, and reduced by any prepaid finance charges, the $50 loan fee, not the $10 service charge, to arrive at the amount financed of $5,000, $25 to $50, equal to $4,975. Conversely, the financial institution may treat the $10 service charge as a prepaid finance charge. If it does, the loan principal would be $5,010. The $5,010 loan principal does not include the $400 precomputed finance charge. The loan principal is increased by other amounts that are financed which are not part of the finance charge, the $25 credit report fee, and reduced by any prepaid finance charges, the $50 loan fee, and the $10 service charge withheld from loan proceeds to arrive at the same amount financed of $5,010.25 to $50.10 equal to $4,975. B. Payment Schedule, Section 1026.18G. For transactions that are not subject 12 CFR 1026.19 E and F, the disclosed payment schedule must reflect all components of the finance charge. It includes all payments scheduled to repay loan principal, interest on the loan, and any other finance charge payable by the consumer after consummation of the transaction. However, any finance charge paid separately before or at consummation, e.g. odd days interest, is not part of the payment schedule. It is a prepaid finance charge that must be reflected as a reduction in the value of the amount financed. At the creditor's option, the payment schedule may include amounts beyond the amount financed and finance charge, e.g., certain insurance premiums or real estate escrow amounts such as taxes added to payments. However, when calculating the APR, the creditor must disregard such amounts. If the obligation is a renewable balloon payment instrument that unconditionally obligates the financial institution to renew the short-term loan. At the consumer's option or to renew the loan subject to conditions within the consumer's control, the payment schedule must be disclosed using the longer term of the renewal period or periods. The long-term loan must be disclosed with a variable rate feature if there are no renewal conditions or if the financial institution guarantees to renew the obligation in a refinancing. The payment schedule must be disclosed using the shorter balloon payment term. The short-term loan must be disclosed as a fixed-rate loan unless it contains a variable rate feature during the initial loan term. CFPB, April 2015, TILA 30. CFPB, Laws and Regulations TILA. C. Annual Percentage Rate Closed-End Credit. Section 1020. The Annual Percentage Rate. Section 1026.22. The APR must be determined under one of the following. The actuarial method, which is defined by Regulation Z and explained in Appendix J to the regulation. The U.S. rule, which is permitted by Regulation Z and briefly explained in Appendix J to the regulation. The U.S. rule is an accrual method that seems to have first surfaced officially in an early 19th century United States Supreme Court case, Story v. Livingston, 38 U.S. 359. 1839. Whichever method is used by the financial institution, the rate calculated will be accurate if it is able to amortize the amount financed while it generates the finance charge under the accrual method selected. Financial institutions also may rely on minor irregularities and accuracy tolerances in the regulation, both of which effectively permit somewhat imprecise, but still legal, APRs to be disclosed. 2. Accuracy tolerances. The disclosed APR on a closed-end transaction is accurate for regular transactions, which include any single advance transaction with equal payments and equal payment periods, or an irregular first payment period and/or a first or last irregular payment. If it is within 1/8 of 1 percentage point of the APR calculated under Regulation Z, 1026.22a. Irregular transactions, which include multiple advance transactions and other transactions not considered regular, if it is within 1/4 of 1 percentage point of the APR calculated under Regulation Z, 1026.22. 1000 mortgage transactions, if it is within 1/8 of 1 percentage point for regular transactions, or 1/4 of 1 percentage point for irregular transactions, or if I. The rate rolled from the disclosed finance charge, and a. The disclosed finance is considered accurate under 12 CFR 1026.18 D1, or 1026.3802 as applicable, or b. The disclosed finance charge is calculated incorrectly but is considered accurate for purposes of rescission under 12 CFR 1026.23 G or H, whichever applies. 1026.22a. CFPB, April 2015, TILA 31. CFPB, Laws and Regulations TILA 2. The disclosed finance charge is calculated incorrectly but is considered accurate under 12 CFR 1026.18 D 1, or 1026.3802, as applicable, or 12 CFR 1026.2, 3G, or H. Either A. The finance charge is understated and the disclosed APR is also understated but is closer to the actual APR than the APR that would be considered accurate under Section 1026.22 of 4, or B. The disclosed finance charge is overstated and the disclosed APR is also overstated but is close to the actual APR than the APR that would be considered accurate under Section 1026.22 of 4. For example, in an irregular transaction subject to a tolerance of 1/4 of 1 percentage point, if the actual APR is 9% and a $7 omission from the finance charge corresponds to a rate of 8.50%, that is considered accurate. Under Section 1026.22a4, a disclosed APR of 8.65% is considered accurate under Section 1026.22f5. However, a disclosed APR below 8.50% or above 9.25% would not be considered accurate. 3. Construction and certain other multiple advance loans pose special problems in computing the finance charge and APR. In many instances, the amount and dates of advances are not predictable with certainty since they depend on the progress of the work. Regulation Z provides that the APR and finance charge for such loans may be estimated for disclosure. At its option, the financial institution may rely on the representations of other parties to acquire necessary information. For example, it might look to the consumer for the dates of advances. In addition, if either the amounts or dates of advances are unknown, even if some of them are known, the financial institution may, at its option, use Appendix D to the regulation to make calculations and disclosures. The finance charge payment schedule obtained through Appendix D may be used with Volume 1 of the CFPB's APR tables, or with any other appropriate computation tool to determine the APR. If the financial institution elects not to use Appendix D, or if Appendix D cannot be applied to a loan, e.g., Appendix D does not apply to a combined construction permanent loan if the payments for the permanent loan begin during the construction period. The financial institution must make its estimates under Section 1026.17c2 and calculate the APR using multiple advance formulas. Construction loans, Section 1026.176 and Appendix D. On loans involving a series of advances under an agreement to extend credit up to a certain amount. A financial institution may treat all of the advances as a single transaction or disclose each advance as a separate transaction. If advances are disclosed separately, disclosures must be provided before each advance occurs, with the disclosures for the first advance provided before consummation. In a transaction that finances the construction of a dwelling that may or will be permanently financed by the same financial institution, the construction permanent financing phases may be disclosed in one of 3 ways listed below. CFPB, April 2015, TILA 32. CFPB, Laws and Regulations TILA. As a single transaction with one disclosure combining both phases. As 2 separate transactions with one disclosure for each phase. As more than 2 transactions with one disclosure for each advance and one for the permanent financing phase. If 2 or more disclosures are furnished, buyer's points or similar amounts imposed on the consumer may be allocated among the transactions in any manner the financial institution chooses, as long as the charges are not applied more than once. In addition, if the financial institution chooses to give 2 sets of disclosures and the consumer is obligated for both construction and permanent phases at the outset, both sets of disclosures must be given to the consumer initially, before consummation of each transaction occurs. If the creditor requires interest reserves for construction loans, special Appendix D rules apply that can make the disclosure calculations quite complicated. Interest reserves included in the commitment amount must not be treated as a prepaid finance charge. If the lender uses Appendix D for construction-only loans with required interest reserves, the lender must estimate construction interest using the interest reserve formula in Appendix D, the lender's own interest reserve. Values must be completely disregarded for disclosure purposes. If the lender uses Appendix D for combination construction permanent loans, the calculations can be much more complex. Appendix D is used to estimate the construction interest, which is then measured against the lender's contractual interest reserves. If the interest reserve portion of the lender's contractual commitment amount exceeds the amount of construction interest estimated under Appendix D, the excess value is considered part of the amount financed if the lender has contracted to disburse those amounts, whether they ultimately are needed to pay for accrued construction interest. If the lender will not disburse the excess amount, if it is not needed to pay for accrued construction interest, the excess amount must be ignored for disclosure purposes. 4. 360-day and 365-day years, Section 1026.17C3. Confusion often arises over whether to use the 360-day or 365-day year in computing interest, particularly when the finance charge is computed by applying a daily rate to an unpaid balance. Many payment loans or loans payable on demand are in this category. There are also loans in this category that call for periodic installment payments. Regulation Z does not require the use of one method of interest computation in preference to another, although state law may. It does, however, permit financial institutions to disregard the fact that months have different numbers of days when calculating and making disclosures. This means financial institutions may base their disclosures on calculation tools that assume all months have an equal number of days, even if their practice is to take account of the variations in months to collect interest. CFPB, April 2015, TILA 33. CFPB, Laws and Regulations TILA. For example, a financial institution may calculate disclosures using a financial calculator based on a 360-day year with 30-day months when, in fact, it collects interest by applying a factor of 1/365 of the annual interest rate to actual days. Disclosure violation may occur, however, when a financial institution applies a daily interest factor based on a 360-day year to the actual number of days between payments. In those situations, the financial institution must disclose the higher values of the finance charge, the APR, and the payment schedule resulting from this practice. For example, a 12% simple interest rate divided by 360 days results in a daily rate of 33,333%. If no charges are imposed except interest, and the amount financed is the same as the loan amount, applying the daily rate on a daily basis for a 365-day year on a $10,000 one-year single payment, unsecured loan results in an APR of 12.17%. 33,333% x 365 equal to 12.17%. x 360. There would be a violation if the APR were disclosed as 12%, or if the finance charge were disclosed as $1,200, 12% x $10,000. However, if there are no other charges except interest, the application of a 360-day year daily rate over 365 days on a regular loan would not result in an APR in excess of the 1/8 of 1 percentage point APR tolerance unless the nominal interest rate is greater than 9%. For irregular loans with 1/4 of 1 percentage point APR tolerance, the nominal interest rate would have to be greater than 18% to exceed the tolerance. Note, notwithstanding the APR tolerance, a creditor's disclosures must reflect the terms of the legal obligation between the parties 1026.17 C1, and the APR must be determined in accordance with either the actuarial method or the U.S. Rule Method 1026.22a. 1. A creditor may not ignore, for disclosure purposes, the effects of applying a 360-day year daily rate over 365 days. Comment 1026.17C3, -1.u. D. Required deposit Section 1026.18R. A required deposit, with certain exceptions, is one that the financial institution requires the consumer to maintain as a condition of the specific credit transaction. It can include a compensating balance or a deposit balance that secures the loan. The effect of a required deposit is not reflected in the APR. Also, a required deposit is not a finance charge, since it is eventually released to the consumer. A deposit that earns at least 5% per year need not be considered a required deposit.